If all of the tariffs were implemented beyond the $200 billion that he's likely to implement sometime in the next few months and possibly in the next few days, but if there were tariffs on all of imports from China or all of China's exports to the US, there would be a very material impact. Our economists are actually forecasting that even with the current $200 billion worth of tariffs that are likely to be implemented shortly, that 2019 and 2020 global GDP growth will be 0.4% lower than we'd thought just a few months ago. And that's worse for emerging markets versus other areas, but the US is equally impacted as across other developed markets. So a very sizable impact that the market might well have adjusted to substantially already in terms of market pricing, but perhaps there is still momentum to this getting worse before it gets better.
I don't want you to necessarily put yourself inside the head of the US president, because that may not be a straightforward place to be, but if you were to be asked percentage-wise, how likely is this to have that kind of negative impact on global GDP, on emerging markets, where would you put that as a likelihood?
Well, there has already been quite a lot of negative impact on emerging markets and to some extent the outlook for global growth. I'd say that there is a better than 50% chance that this is going to have a further impact. But there's quite a lot of games being played at the moment. You're just talking about the negotiations with Europe and Canada. All of these need to be put in the context of essentially a longer-term strategic game that's being played against China, primarily as the main strategic threat to US dominance around the world economically and militarily. So, and then inside of that, you've also got complications around midterm elections because, for example, it may not be in Trump's interests to accelerate a trade war into those elections. So even these $200 billion worth of tariffs that Trump could implement immediately, now that they've gone through the public consultation period, he may decide that actually there's a reason to defer the implementation of those until after the election, because the implementation of these tariffs may actually be the next thing that starts to cause more pressure to feed back into the US economy. And that's really what might be the circuit breaker for this. We need to see an actual negative impact of what Trump's policies could do to global growth impact the US directly before perhaps there might be a reprieve from either Trump's policy advance on trade or the Fed's advance on rate hikes.
I want to pick up on that feedback loop, actually, because as you say, tariffs do work with a lag. We're not really seeing much of an impact yet on US growth. Are you expecting the tariffs to start biting come next year? And also, what do you think that means for the Fed? Because we know that we're likely to get another hike soon. December is pretty much on the table as well. Do you think that the Fed will be able to continue with their hiking trajectory so long as the US is engaging in this trade war with the rest of the world?
Yeah, so it's certainly our base case from our economists now that the $200 billion worth of tariffs will get implemented, whether it's sooner or later in terms of potentially slightly after the election, and that will reduce global growth next year. And that has two reasons. First of all, there could be a direct demand impact, but also that size of tariffs against China is likely to have supply chain impacts. You've heard Apple talking about the consequences on a variety of their products that are imported from China. So it should have a negative growth impact, but potentially a positive inflation impact. That's part of the reason why for the US we've downgraded GDP growth for the next 2 years, but also downgraded our rate hike expectations. We're still expecting 5 hikes over the next few years towards the peak Fed rate, but it was 7 a few months ago, so our expectations are lower. Now, if the trade war advances further, because that's only our base case scenario, things could get worse, you could see the Fed really step back. But the Fed won't choose to do that, particularly while inflation pressures are building and particularly while trade policy is contributing to inflationary pressures, until there is actually a direct and obvious economic impact that's coming through in the US, whether it's through financial stress, markets falling, or through GDP and other leading indicators, some leading indicators suggesting that demand is going to weaken. But nonetheless, that's what we're looking out for in the next 6 months and needing to adapt to. We're keeping very balanced positions. We've been increasing some of our diversification positions, like being short Korean won recently, also shorting the NASDAQ against the broader US market, because these are typically very cyclical plays that will benefit in that weakening environment. But we do still have plenty of risk-on positions actually in emerging markets where a lot is now in the price, and there's a huge bifurcation between where US assets are being priced and emerging markets assets are being priced. And actually there is room to start taking some risk in these now much cheaper emerging market assets, whether it's bonds or equities.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.